Alright, what is up guys? It is John Fibonacci here, and this is shorting above the open in bearish conditions part 2. Alright? So, our learning objectives for today are going to be an outline of shorting above the open. We're going to have some chart examples and then a homework recommendation. So, as always, got to give credit to where it's due. So, credit must be given to Larry Williams, all right, who's published many books, which you guys already know. We recommend a lot of these already. How I Made $1 Million Last Year Trading Commodities, Secrets for Selecting Stocks, Long-Term Secrets to Short-Term Trading, and Sure Thing Commodity Trading, as well as others. And in addition to that, credit must also be given to George Angel, who's written more books than this as well, but some of the ones that I have and highlighted are Winning in the Commodities Market, Winning in the Futures Market, and How to Triple Your Money Every Year with Stock Index Futures. All right, an outline of shorting above the open. So, noting the opening price of the day, the ideal opening price would be London Open or New York Open. And of course, this is actually going to be tailored to day trading. All right, day trading, which means intraday time frame. All right, so you might hold for a couple of hours or possibly a couple of days, but we're really going to be focused on intraday trading, and I know a lot of you guys do that, so there you go. All right, the London opening price is ideal for EURUSD and GBPUSD. That is my personal preference for fiber and cable. I like the London open prices. And New York open is ideal for the indices such as the S&P 500, the NASDAQ, and the Dow Jones. And even this week, actually, of the week that I'm recording this, we had some divergences that occurred after the New York Open, even though it was given to you on the London Open session. All right. As always, do not forget about the top-down analysis, right? The top-down approach, where we are able to work from the higher time frames down to the lower. So whether it be from weekly, daily, 4-hour, or daily 4-hour, 1 hour, or whatever the case is, don't forget that, because the whole idea is to align the high time frames and the low time frames together for the highest probability of a winning trade. Okay, so the ideal entries are smart money concepts, and I haven't listed them all here for you, but here are a couple, right? The institutional candles, imbalances, 80s and 20s, and also the 50s or the quarter levels, right? The divergence, which we actually went over a lot this week, and more. All right, but I'm not gonna go over all of them. Just like in the first one, we can't go over everything in one video. All right, so here is the outline continued. We're going to be taking a look at a hypothetical scenario. We're going to be looking at the same time, a hypothetical candle and hypothetical intraday price action. Okay, so this is what that looks like. On the left side, you have your daily candle, which is actually what we're going to be studying today, but don't forget that it can also work for the weekly and for the monthly as well. So again, just a quick reminder, we will be focusing on day trading, intraday trading, but it's up to you to look for weekly and monthly for this type of stuff. All right, but nonetheless, on the left side of the chart, you have your open, right? You have your open, and price rallies, and then drops, and you have your closing price. So in between the open and the close, you have your movements, right? So if we're in a bearish condition, right, that means the candle is going to close below the open, right, for a down candle. Then any movement that is above the open is what I consider a false rally, which in other words is manipulation, okay, price manipulation. That comes from both Larry Williams and George Angel. And there are other mentors out there. I believe like Sam Seiden talks a little bit about it. I don't think he's as specific though, but nonetheless, if you just kind of piece a lot of things together from the different mentors, from the different book recommendations, this is ultimately what you get. So shorting above that open, you want to short as price is going higher into that false rally, is what I'm saying. So later in the day or whatever time frame you're trading, that little rally at the end of the day is going to be short covering, which is profit taking or distribution. So it would be maybe distributing their short positions, right? And that's what short covering is. And so just a quick reminder, guys, when you're in a short position and you close out of your short, you are technically buying back your position. So when smart money is short covering, then that influx of closing shorts is going to be an influx of buying. So you are usually going to see that little rally at the end of the day. Now notice, okay, I also have named it profit taking. All right, now that really comes with the indices. I'm going to do a lesson on that at some point in the future, but there's a reason for everything that we do. There's a reason that everything is called something that it's called, like the false rally, all right, and short covering. Okay, so intraday, this is what that would look like. You would have your opening, say this is a 5-minute chart. Okay, you would have your opening price, and then price would rally and then drop and eventually come down, and then this is your short covering slash profit taking or distribution. Price would rally and then close for the day or close for the week, whatever time frame. All right, so it's basically the same thing. All right, this is your day or weekly, monthly, and this is what the intraday would look like. And so by open, just like we talked about a minute ago, remember, it may not necessarily be the opening of the day, but rather the opening of the session. Okay, so if we were looking at this would say, for example, be Euro USD, and the opening would be London Open, and then the close would be later on in the afternoon. All right, at least for Central Time or Eastern Standard Time, it'd be later in the afternoon, depending. All right. Now that's, of course, not taking into consideration profit targets. Like say we have equal lows, you can exit on that. You don't necessarily have to exit at a certain time. All right. So, but yeah, this is what that would look like. Or for the indices, if this was what we were anticipating for the indices, this would be New York opening price, and then we would want to short above that. Okay. So I know that kind of seems like a lot. Maybe to some of you it might be, but there you go. All right. So now for the examples. Okay, so what we are looking at is the British pound versus the US dollar and Euro USD. All right, basically fiber and cable. Okay, so on the daily time frame, right, Euro GBP was rallying higher, which means that British pound was weaker than euro. So that means shorting opportunities should be taken on British pound instead of the euro. Okay, and then also the divergence between GBP USD and Euro USD also indicates weakness on the side of British pound. Okay, so the black and white candles are going to be GBP, and the ghost feed, if you will, is what I've been calling it, is what's on the bottom. So let me just use my mouse really quick. the price action here on the bottom is the Euro USD. So the divergence, I didn't annotate it, but you can kind of see it, right? Because you have British pound going lower here, and at the same time, the Euro USD was actually running equal highs over here. So the Euro USD technically went higher here at the same time that British pound was going lower. So when you have that lower British pound, right, that's indicating weakness. All right. And so here is your London opening price. So we were already bearish to begin with. So we annotate that London open. Price then rallies, right? That false rally higher, just like I showed you on the previous slide. There is your false rally. It smacks right into that institutional candle and then sells off later into into a few hours after London opens. Now, did it eventually go higher? Yes, it did. But nonetheless, there was still an opportunity to trade short. So if you had hypothetically taken a entry at the institutional candle with a stop loss above this high right here, the very low of these bodies right here, there was a 1 to 12 offered. Now be careful, because I'm not saying that this was a 1 to 12 trade. It's just for illustration purposes, there was 12 times of profit of potential risk. So if we were risking, say, 10 pips, then there was 120 offered on the downside, is what I'm trying to get at. If it was me, I probably would have gotten out at this new low here. So maybe like a 1 to 6 or 1 to 7, something like that. So don't get that confused. I'm just giving you the max potential on that was a 1 to 12 offered here intraday. Okay. And of course, that's also touching on the top-down analysis, because again, we have the daily doing this, and that's how we were able to intraday find a setup. All right, so there it is. So British pound on the 15-minute time frame, and this is a different setup, but nonetheless, here's pretty much what you have. So George Angel is one of the ones who introduced that the floor traders run stops, and that's in multiple books. That's not just one or two. That's pretty much all the ones that I've read, at least from him. So the previous day high, we would anticipate that there's liquidity up in there, right? And that's on here for you. Literally, it says previous day high. That's right here. And so price is able to run the previous day high, and then here's your London opening price right there in that orange circle. Okay, I want to make that easy for you to tell. So that orange circle is London open. Price drops a little bit, but then it rallies above the open. Okay, and it's trading right around that 20 level. Okay, so that would be 1.3020. So 3020. Okay, and then price is able to drop. Right? A lot of you would consider this a break of structure. Okay. And then price rallies up one more time into this imbalance. And the imbalance would be from this candle's high up to this candle's low. It taps right in there, which is actually a little bit above the 80 level. And so, of course, the 20s and 80s were accumulation of shorts, because we can tell that price stayed around there for a little bit, and even right in here, right? Look at the candle bodies. If you can see that, the candle bodies were respecting that 80 level, all right? Price dropped a total of 220 pips intraday on British pound. That's pretty phenomenal. That's a lot of pips, all right? And then look where profit taking was occurring. Look where that short covering was occurring at that 80 level. So that would be 127.80 right there. Perfect. All right. And this is that hypothetical candle that I was telling you about, where your London opening price would be here, that false rally higher, which is here. And then price, really went to the downside. And then I didn't draw the rest of it because there's price action over here, but essentially, all right, it's that candle. All right, so there you go. All right, so we're taking a look at the Euro USD on a 15-minute time frame. And just like I said on the last slide, George Angel, he talks about a search and destroy type of day. And of course, I'm going to let you read about it, but I'll try and keep it short and to the point. Basically, what a search and destroy day is where the market takes out both the previous day's high and also the previous day's low. And so you see that on this day here, on the 4th, you had your London opening price. Price rallied above these equal highs here. Also ran the previous day's high, not by much, not by very much, but nonetheless, it still ran previous day's highs and then collapsed. Okay, and then for New York, price ran the previous day's low and then reversed and went back above the London open. So this is what that candle would look like from the perspective of London open, where we rallied, went all the way down here, and then came back up and then closed near where the London opening price was at. So there was opportunities to really go short, right? You could fade the equal highs, maybe take a little bit of drawdown on that previous day's high, or maybe you played a small retracement in here. You know, there's a number of opportunities, you know, depending on, you know, what trade plan you have. But nonetheless, so beautiful day in the markets there, where if you were in bearish conditions, you know, you could have really did well shorting above London open. So there you go. And then of course, there's highs, or not highs, sorry, there's eyes, there's lows, right? And the eyeball, you guys already know, is a representation of liquidity, right? So there you have it. And that's it. All right, so here is Aussie, right? AUDUSD on a 15-minute time frame. And in this example, you would have consolidation. So you would actually have equal highs and equal lows. All right, so basically price, quote unquote, broke out, right? There was a breakout to the upside, and then it ran this high from over here, right? Our eyeball, that's what that is, runs into that 20 level right in here, and I drew a fractal. This is a fractal high because you have this candle's high, and then the candle to the right is lower, and the candle to the left is lower, so that's a 3-bar fractal right there. And that's also, I know it's kind of cut off, that's my mistake on that, but that is your London open, I think. No, that was New York open, sorry, right around 8:30. So yeah, that was New York open. Price rallied and then collapsed. So moving from that 20 level down to the equal lows and smacking that 50 level right here at 72.50. So about 70 pips intraday for Australian dollar. All right. And of course, that's price manipulation because we don't trade breakouts here. We fade the breakouts because anyone who tried to buy this or bought it on the way higher, if they did not take any profits off the table, they're getting wrecked when price reverses, right? And that's why we don't trade with buy stops or sell stops, because even look at the sell stops, right? Below the equal lows, they got triggered here and then price reversed. Okay, so they got crushed. All right, so that's it. And I got another example. So here is Australian dollar 15-minute time frame again, where you have equal lows, and I'm guessing that's probably the previous day's low as well for Australian dollar. And then so price takes that equal lows, sets a low, and then rallies higher for equal highs, and then comes back down into the middle of the range. Then you have London open, right? So London open, price rallies, it trades right into this institutional candle here, right? This is that up candle prior to the strong sell-off. This is 50% of the institutional candle, so it kisses that right there, and then really trades lower, ultimately grabbing this liquidity here. So there's your open, false rally, boom. price drops lower. All right. So this is the final part of the video. This is your homework recommendation. And it's going to sound like a lot, but it is what it is. All right. Study the opening prices for EURUSD and GBPUSD from the London Open. Be sure to look for institutional candles, divergence, 80s, 20s, and other smart money concepts. Find 25 examples for each major currency pair. Okay, so go in, mark your chart, and find examples, right? You know, save them to your computer or print them out, whatever you want to do. 25 examples for each major currency pair. So how many is that? Okay, that's a lot because there are a few major currencies, right? So that's going to be around 200 charts. All right, so get to working. All right. After that, okay, study the opening prices for the indices from the New York Open. Same thing as before, right? Be sure to look for smart money concepts, you know, whichever ones that you look for. I do recommend looking at all of them. All right, each setup's going to be a little bit different. Some of them might be very similar, but, you know, each moment in the market is unique, right? Shout out to Mark Douglas, right? So find 25 examples for each index. That would be the S&P, the Dow Jones, and the NASDAQ. Now there is a Russell 2000. I don't really look at the Russell 2000, so that's going to be up to you. So for me, that would be probably about 75 charts or so. So a little bit more on the Forex side, a little bit less on the indices side, but you know, it's all good. So that all in all should be about 275 charts, which to me, it's doable, guys. It's doable. All right. And the person who says I can and I can't are both right. Right. Thanks, Confucius, for that one. This should be able to increase your understanding about price movements, and you learn by experience. So you must put in the hours and familiarize yourself with this concept. And I know it sounds like a lot, but have fun.